The last 2 days of trading have been very unusual. Volumes are down across the board, and of course, the range is getting tighter. This is all ahead of the biggest monthly news that comes out of the US, the inflation figures. And we've got JP Morgan's game plan today to discuss, along with our bearish and bullish case thoughts, depending on how this number clears. We'll also be taking a look at the data coming out about some of the tech sectors around the world. And it might not be the one that you're thinking about, but I'll tell you this thing, it is very scary what happens usually over the next 12 months when we get reads like this. Let's take a look at stocks, commodities, and cryptos right now. Well, welcome back everybody to the Daily Show where we talk about markets around the world. Today we'll be discussing central bank liquidity along with our thoughts on the news, macro, lead indicators, and of course, the hottest charts with the key levels. If it's your first time here, welcome to the community. Subscribe, smash that like button. I'm sure you're going to find value in today's video. So Goldman Sachs and JP Morgan both believe stocks will rally if inflation data is soft. This is going to be a very big event. Generally speaking, when we talk about inflation numbers, you're usually looking at a decline followed by a spike and then further declines. That is, if the Federal Reserve is doing their job. It's not all the way down. The question is going to be, when do we see the slight spike? Is it this month? Is it because of energy prices coming through in that shock that we saw only a month ago? Well, this is the question, and this is, of course, the game plan that JP Morgan's put together. I shared this over on our Twitter. If you're interested in following at FX Evolution, links in the description down below with the link tree. Let's move over here to what they believe is going to happen. Of course, probabilities are important. Most people believe it's going to be stuck between 5% and 5.5% in terms of CPI. And this will usually mean a big change in markets. If it comes in a little bit hotter than expected, let's say 5.3 to 5.5, JP Morgan believe the market is going to tank and basically move back into demand levels we'll talk about later on when we look at the S&P 500. If it comes in on expectation, they believe the markets will go up and break this tight range. So which one will it be? Well, let's start to talk about some of the things going on in the markets as we bleed into some chess-style scenarios. First up, we need an update on what's going on with central bank liquidity. As I've mentioned, we've got the US here and kind of like an aggregate number on this purple line. And we've seen in recent weeks, especially since the banks, the other regional banks started getting tightening, the reverse repo market has had some action. So while the Fed's saying on one hand, oh, we're not doing anything, don't worry, guys, they are certainly supporting the market. That led to, of course, a bit of a dead cat bounce potentially in this distribution, and we've gone back up. We, of course, had that snap, those hedges coming off as well from the most hedged event, which was the FOMC last week. And it didn't really represent anything in particular. We saw a sell and then we saw, of course, a buy. Let's move over to VIX 1 days. This is the VIX chart that we probably need to start looking at nowadays. We know that everything changed thanks to zero DTEs. So we expect, of course, volatility to spike into an event such as this. You can see it did spike. And if the number is not what the market expects, I would expect VIX 1Ds to actually go up. And of course, if we see fear coming into the markets, which generally is what the VIX is seen as, that usually means the downside is coming. You can clearly see here, though, the ramp is nowhere near as much as it has been in the last. All of these numbers here are either CPIs or FOMC events. So clearly the market is not freaked out as much as it needs to. It's become complacent over the last couple of months. Now, I've seen some comments down below and people are saying, where is the updated FOMC dot plot? We will get one soon, but of course we won't get it just yet. I've just loaded up here the latest one, which we of course have from March, which shows that the Fed was basically saying, we are going to stick to the plan of holding rates for 2023 and cutting them a little bit in 2024. This is probably the most important thing for investors and middle-term swingers over the next 3 to 9 months because it's a complete opposite to what the market is pricing in. This is the chart of what the market is doing. You can see it's all about cuts coming through September of this year into October, into December. I still don't think the market's got it right here. I think 75 basis points worth of cuts is too many. But what do you think in the comments down below? I will load a few of those comments tomorrow when we discuss it a little bit in more detail. So stick around for that show. But yeah, it's very important to note that the market is really expecting drastic cuts. On average, once the Fed has hit its terminal rate, which is the highest rate it's going to go to, very arguable they've just done that, they tend to hold it for 6 months. Okay, so 4 to 6 months is usually the average through there. On some other concerning notes, we've just hit a new all-time record for the top 2 stocks from 1980 all the way over to 2023. We've never seen such saturation of companies being the leaders of the stock market. 14% of the S&P 500 is now 2 stocks. And guess what they are? Well, of course, it's Apple and Microsoft. Well, yes, they're great stocks, Microsoft being my favorite stock in the market. But geez, I tell you what, they are a huge part now. And if they start to fall off when we look at the resistances being formed, things could get a little nasty for the S&P pretty quickly. Let's also talk about lost decades. I just want to bring this up because there are different ways to invest in lost decades. Now, it's very arguable that we could be going into a slower time for the S&P 500 moving forward. We've just seen an incredible bull run of some of the biggest stocks in the world. We're obviously seeing that right now. But pretty much the US has always had these types of cyclical events. They've had points where the S&P 500 hasn't done so well. Small caps have done very well. Then points where large caps have done very well. Small caps have done very poorly. And these areas often coincide with what we call the lost decade. There's a good chance that sometime later on, after all of this stuff kind of blows over, that actually small caps may outperform large caps. And I believe a lot of that's got to do with innovation coming from AI. Think about how fast and nimble some companies are. Let's go with Adobe for a question. Now, Adobe is, of course, enriching their product at the moment with AI software. What if, though, for example, there were other people taking advantage of some of these open source AI programs and they were able to perform or create a very similar, more like cheaper, cost-effective, nimble kind of business? Maybe we're already starting to see that with DaVinci versus Premiere in the video side. So, of course, this is going to be where the battlefield is. It's going to be AI, and I do believe that innovation is going to come out of here. So, interesting to start looking at small caps, I believe, in the future as well, if you're an investor. And I know we have a lot of investors that follow this channel. What do you think? Comments down below. Let's go through it soon. Now, Chinese tech stocks, are they doing well? The answer is no. The question is, are they value at this stage? Yes, I did say it was going to be a tech area that you might not have considered recently, but I have seen in the comment section people talking about Baba and other tech stocks. Well, here are some of the switches we've got here. Big bullish momentum switches coming from the reopening, coming from the stimulus, but that has totally soured in recent months. It's gone all the way back down. And when we see these reads, which we have quite a few reads actually over time, take a look at some of these stats. Now, if I was showing you these stats for the S&P 500, you'd be horrified. 45% of the time, the market is up by the end of seeing a stat like this over 12 months. Look at the average. 10.8% down is the average. Max loss, 21.7%. So this is not good. And we've seen this happen a few times in China. And obviously, it's not the kind of thing that you'd want to be necessarily going out and saying, oh, well, look at the bargain. With deglobalization, you can really see it coming through here. A lot of big players are moving into India and other markets. And again, the stats are just brutal. 33% of the time, the market will be bullish. Generally, it's down over 17% over this period. Now, that doesn't mean we just go sell it, but it just is a cautionary tale in terms of what we're seeing on the data. Let's move over here to smart money versus dumb money. I haven't really updated this chart. It's pretty much the same though. It's from a day ago. They're sitting flatlining on each other. No one really has any idea whether we should be breaching to the upside or the downside. And that's because there's a compelling argument for both ends. And we'll talk about it a little bit later on. For investors, I just want to always reiterate, one of my favorite indicators is forward PE. I will get an update on this after earnings season, which obviously we're still going through right now. And we're still trading well above the 16.8. We're about 18 point something at this stage. So it's not really cheap to be necessarily looking at the market at this point. What about hedge fund managers? What about the biggest players in the game? What are they doing? They are still positioned neutral at this stage. They haven't really gone all in on the market, which usually is coming up with the 600 to 800,000. That's when you kind of say, well, they're undeniably buying pretty heavy positions. And they were very negative all the way through the middle of 21, all the way till pretty much October of last year. And they started getting neutral on the market, and we find ourselves here. And that's the problem. Everyone's neutral. Everyone's questioning everything about this market. And that's why it's basically just the QE stocks that are doing well. So when we see those central bank numbers going up, which we have seen, which is liquidity in the back end, people are just going to, what's the game plan? Buy top 10 tech stocks. That's all they're doing. They're just like, top 10 tech stocks, let's buy those. We'll sit there and we'll figure out what happens. They're kind of defensive anyway. Let's move over to sector rotation. It was a day of nothingness. You can see there was still some moves through the rotationals, but no big news coming through there. We'll go to the 5-day here, and it's a little bit different story. Obviously, we still have weakness in the regional banks, though that did get squeezed through last Friday, as we talked about. And I'm not sure if I'd really... The first couple of days of squeeze were excellent, but usually it's short-lived. So you've got to be a bit careful with the squeeze play. I think a lot of people are getting on board that. I wouldn't be surprised if the market does a bit of punishment there. So be careful if you're trying to squeeze KRE out. GDX doing the best, which is gold. It has become the prominent sector of rotation over the last 3 months. We'll do a special on that along with our rotational concepts moving forward. So make sure to stick around, subscribe if you're interested. Let's move into the charts now. We'll start off with RSP. This is the equal weighted S&P 500, and it shows us that the market is not so healthy. Obviously, we know breadth is well down, and we haven't got breakouts either way. So we have no signal, bearish or bullish. If you were guessing here, you would obviously be pulling the fibs, which we did. 61.8 on this particular high to low scenario is where the fib is. And we made a new low on RSP, but we know inflation numbers can completely blow these out. Let's move through some other things. Copper. Are we going to hit a double bottom and then rally? Or is this going to finally get through 3.8 into 3.7, which will be the next move? And if we go under 3.7, well, the markets will be in trouble. We know Dr. Copper is super important. Demand destruction. This is what it's showing us, and we will be following it very closely over the next 24 hours. Let's move over to junk bonds. No information here. The most boring session ever for junk bonds. Look at that little sitting in the middle of nowhere land. So will it break down or up? We don't know yet, and that's okay. We'll keep going through. Treasuries are going to come under some further pressure. I think we've seen the price action we need to see. It's most likely going back down to 100 in anticipation of things like, well, it's actually two things I think that are occurring. Number one is, of course, the debt ceiling issue. That will be sorted, but it will be protracted and annoying, and it does hurt some treasuries and potentially offer opportunities for people if they're risk takers in the treasury field. And the other thing that I think is happening here is that the market is starting to say, well, maybe the Fed won't cut as much and yields are coming up a little bit. Now, because yields are coming up a little bit on the forward horizon, that's going to put pressure on treasuries a little bit, on the US 10-year, 20-year, etc. And then what's going to go is that we might see a decline into, of course, movement through. Remember, you're looking for the US 10-year to make underneath, I think it's 3.32 or whatever it was, to basically make treasuries, great again. And yeah, it's 3.3 flat pretty much. We need it under there. If it gets underneath there, that should really rally treasuries quite a lot. Dollar index, let's take a look at this one in the middle of its own accumulation or distribution. Weeklies would have you guessing that it is a distribution into a short based on the closure here is not very good. You get a lot of wicks that, of course, have come off. We have an outside and a long leg doji, so we don't actually have direction yet. And that's the thing that's a bit frustrating. Though it did hit one of our targets. If you were like kind of long based on this entry here, which is an excellent entry, don't get me wrong, this would have been my first target. So I think this target, maybe even the total target based on the CPI number just being too scary from each way being very, very real. And we just don't know which way it's going to go yet. Daily doesn't give us too much. We have some closures above these levels, but you could make a case here. You could make a case here. I don't think we have edge. And as I say, patience, react, don't predict is one of the key things. You'd have to go with downtrend is still the trend. If we move over to the euro here quickly, just to see, The euro came into the demand and it's finding some buyers. Not enough yet. It did break through that long-standing trend line. But as I say, selling a dulling market is difficult. So I'm not sure whether that was the best move. And I think a lot of people have jumped on the sell train. You've got to be very, very careful. Gold's been a little bit simpler. It moved